Hey guys, in this video, I'm going to answer the question, what should I do with my 401k? The most popular question I get from people who learn that I have experience in the financial markets is, what should I do with my 401k? How should I manage my retirement savings? So first of all, before I share my perspective, just a caveat, I am not a registered financial advisor or a certified financial planner. Before you make any decisions regarding your retirement accounts or your money, seek out an investment professional, a trusted advisor who will sit down with you and help you make these decisions. So with that, what I do when I consider my retirement savings is I survey the market probably once every 6 months. When I say survey the market, you're going to say, Ken, I don't know anything about the markets. I don't know what I'm doing. I don't know. I'm going to show you a simple way just to get a big picture look of what's happening and get a feel for what your risk is in the market. So this is tradingview.com, and I've got a picture of the S&P 500. So the S&P 500 is the granddaddy of all stock indices. It has 500 of the heavily market capped and heavily traded stocks in the US. This is a good indicator of just overall how the stock market's doing. This is the benchmark that fund managers try to beat every year. They try to outperform the S&P 500, and many of them don't. So this is the big picture view, and I could teach this to an 8-year-old. How do you know what's going on? How do you gauge the health of the market? Well, look at the chart. What does it look like? Is it going up? Is it going down? What's happening? So I'm going to flip this to the year-to-date view. Let's talk about that real quick. The year-to-date view looks pretty good. If I asked you, hey, which way is the market going? In a general sense, with some choppiness, you can see at least to the beginning of the year, it was going up. And now it's kind of resumed this going up. So all in all, it's got an upward incline. This is a year-to-date chart. So looking at this today, it doesn't look too horrible. Yeah, there's some retracements and that kind of thing, but you've got this up thing. That's year-to-date. That's from January to now. And actually the return on this is about 18%. So it's really, really good. So if you invested in January and you had your money now, you'd be up approximately 18. This says 20%, but I'm going to show you a different view. So this is year to year. So this is September of 2018 to September of 2019 now. And this paints a little bit different picture. You can see the end of last year, we had a huge decline. The markets faced a lot of trouble, and there was some huge losses at the end of the year, and now we've kind of recovered those and we're up a little bit. So truth be told, year on year from September of last year to this year, we're only up about 3%, 3.5%. And that's not a huge gain considering all this risk. So the risk to the downside, we especially saw it in August. These moves here, they were down. These were things with mentions of the trade war with China in the media. The president would tweet something, and the market would drop like 3% in a day. And strangely enough, in the past week, just about a week ago, we were only up about 1% for the year-to-year on the S&P 500. So a week ago, we were up like 1.5%. That's from last September of 2018. So for the entire year, you'd be up 1%. And there's a lot of risk in here. So for me, when I do my 6-month evaluation, I look at stuff like this and I say, am I allocated correctly? What does that mean? Do I have my money in the right places considering what's going on in the market? So again, would I consider this chart, and this is just a year, I still think of from a retirement perspective, a year is a very short time frame, but with all this risk, my opinion is the upside is limited. We've had a really good run over the 5-year period. Here's the 5-year chart in the S&P. So this goes way back, but from 2016 till now, there's been a really good uptrend. There's a lot of gains, right? And hopefully you've enjoyed them too. At this point, with a lot of the uncertainty in the market, I am looking to protect what I've made in those last 3 years. So I think there's more of potential for the market to hiccup and give up 8 to 10% in the next year, and I don't see the probability of 8 to 10% gains in the next year versus declines. So what I've done is I've changed my allocation and I've changed my contributions. So my allocation, that means the money that's in the account, I've actually put 70% of it in bonds. Bonds are a lot less risky than stocks. Generally, when stocks don't do well, bonds fare a bit better. If the market has declines, bonds don't necessarily go down. And during these rough times, I watch the market, and my bond allocations actually gained about 0.5% during these times. So sometimes they're not a safe haven, but people will go to the less risky investment when they have to place their money. So when you see these rough times, the market drops 3%. Let's say my bond fund for the day was up 0.25% or 0.5% or something like that. So I moved the money that's in my account to 70% bonds. So there's an important distinction there too. When you talk to your financial advisor, your banker, or whoever that is, besides just the main allocation, the money that's in the account, consider where your future contributions are going to. Generally, those settings are different, and you can adjust them. So I've also adjusted my future contributions for now, at least for the next 6-month period, to go 70% into bonds as well, and then 30% into stocks. So I took the money that was in there, I reduced the risk. I also adjusted my future contributions, my next paychecks that go into the 401k. I also want them with that same allocation. They're going to go 70% into bonds and only 30% into stocks. So again, this is just for me, but these are I just kind of wanted to open up the chart and show you the bigger picture so you can have this conversation with those who help you make these decisions. Ask them, hey, is my allocation right for where we are in the markets? Maybe you've been very prosperous, you've had a good return. Sometimes it's okay to play a little bit defensive, and 6 months from now you can reevaluate it. So with that, yeah, I may miss out if the market goes up 10%. I will not get those returns. Maybe bonds will fare well. I'll get the returns from my 30% allocation in stocks. So if the market goes up 10%, maybe I gain 3%. But from a defensive side, from a risk side, I think I'm much better positioned for a downturn in the markets, or even a recession, or some kind of surprise move downward like this. I'll be sitting pretty, and I won't give up very many gains. The other thing to consider when investing is any kind of decline in your account value actually takes a greater percentage gain to recoup those losses. So what do I mean? Let's say you have $100,000 and the market declines 10%. So at the close of the day, your funds are reevaluated and the values assessed to them. So if you had $100,000, the market declined 10%, you'd have $90,000. So how do you get back to even? How do you get back to $100,000? Well, it's not just a 10% increase you need. You need more than that. If you had the market rise 10% the next day, you would only be at $99,000. You'd gain $9,000, but you'd still be short of where you were before. So it's something to keep in mind as the market declines and your assets shrink. You need a greater return in the future to recoup those assets because it's calculated on a day-to-day basis. But really, that's it. That's what I wanted to cover. This is kind of my 6-month assessment of the market. I just think there's a lot of risk in here for me, and for me, I decided to play it a little bit safer and minimize my risk because I think there's a higher probability of a downturn than an upturn. And again, it's an educated guess. That's all we can do. I can't predict the future. All I can do is look at the data and figure out how I want to protect myself. So I hope that helps. Have those conversations with those who help you manage your money. And as always, take a look at the data, find the patterns, and manage your risk. I'll see you next time.